So, in last episode of Options 101, we kind of discussed how buying a call is you reserving the right to buy 100 shares at the specified price. So, essentially, if I wanted to buy 100 shares of SPY at $446 on some date, I would pay a premium. In this date, let's say it would be $1.37. So, that's $1.37 a share I'm giving to someone today for the right to buy 100 shares at $446 a share. So that makes my, overall price $447.37. You lose that premium when you're buying. Now, you can sell the right for someone to buy shares from you at that price. And then there's the put side. Now, the put side, this is interesting, is essentially, let's say I buy a put that gives me the right to sell someone 100 shares at the specified price. So if I were to buy a put, I could sell someone the shares at $446. That gives me the right to do this. Now, there's a difference between rights and obligations. So currently, I have the right to sell someone those shares. I may not own the shares, so that would be kind of tricky if you figure that out. Um, Essentially, this is a way to mitigate risk for people who own 100 shares of something. Say they think the market's going to go down pretty drastically. So for the premium of $133, I can sell my shares at $446, regardless of what the market does if it's a downward fashion. So if all of a sudden tomorrow SPY crashes down to $400, I can sell my shares at $446 to some schmuck who sold me that option because I have the right to do that. They, on the selling side of that, have the obligation to purchase those shares at $446. So there's a thing that can happen where you get exercised early. So that means before the date that the contract is expiring, that you can be assigned shares because someone exercised their right to make you purchase those shares, or on the call side, they exercise their right to buy those shares from you at that price. So selling gives you an obligation, and buying gives you the right. So remember that one is, you have to do the thing, the other is you can do the thing. So those are the big ones. And now for the fun part, what happens when you have two of these things put together? So if we go on the call side, what you can do is this is kind of fun. Let's say that you believe that the stock market's going to go up this week. So let's say on what's today? Sunday. So Monday, Tuesday, Wednesday. So let's say you think the stock market's going to go up, up to 450 bucks. So what you can do is you can buy this one 445, which gives you the right to purchase 100 shares at $445, and then you can sell this 451. Now let's go to sell. Always make sure you check these things. All right, so there's that. Now, if you take a look here, that gives you the obligation to sell someone 100 shares. So let's say that on Wednesday, three things could happen. Let's go through the first scenario. SPY does very well and it goes up to 455. So you have the right to buy at 445 and the obligation to sell at 450. Now you've collected an $81 premium for the right or the obligation to sell at 450. So you basically have collected $500 total if it expires above $450. At 455, you're well above that. So the total cost to you, because you were trying to make this one cheaper to buy, so if you subtract 81 cents out of 307, you get $226. So it costs you a total of $226 for this option play. Now, why would you do that? So basically you've capped your upside. You can't get more than 450 because you have to sell at 450. So when you do that, essentially what you've done is said, I will make this much money. So this is a $5 spread. This is a call debit spread. And so it's a debit because you've put money into it. They're called credit spreads, which are the inverse of this. And we'll talk about that in a second. I'm getting ahead of myself. So the call debit spread is a bullish stock play. And assuming that it breaks above 450, the money you put in, that 226, you subtract five, because this is a $5 spread, so you subtract 226 from 500. So if we do that, your total should be roughly $273 would be your maximum profit. A double up, very nice, excellent. Now, why is that? That's because you've basically taken 500 and you subtracted 227 from it. So if you add these two up, 273 plus 227, you should get $500. That's all good and dandy if it stays above $450 the entire time you hold this. Now, what if it doesn't? What if it finishes off at 448? Well, if you've held to expiration, which I don't recommend doing on these things, I always recommend selling before you have to, because things can happen after hours, especially in an S&P SPY call sell thing. Things go nuts a little bit after. So like 5 o'clock, this can still be going. It can be crazy. So if it's close to your break even points, sell it. So let's say it finishes at 448. That's between them. So that makes your 450 sold thing worthless. So you've collected that premium. But that does mean that you have to sell your you've basically put yourself into a place where you purchase a thing and at expiration you are going to basically buy 100 shares of this at 445. So it's at 448. So there's a $3 difference there. So that's 300 bucks. Now, if you were to immediately sell those at 448, then congratulations, you've netted roughly, you know, $81 because for simplicity's sake, let's say that at $307 in and you're at 300, so let's just call it an even 300. You're $3 above where you bought them. We're going to wipe that out and say that you basically made your $81 a premium. That's it. Now, what happens if it goes down below the 445 mark at expiration? Well, you've capped your downside too with this. With the money you've put in, that's the most money you can lose. Kind of. So if it goes down to 444 or lower, or 440, anything 440, 499, then both of these have expired worthless, which means you've lost the $307 you put into this, but you've gained that 81. So you're really only down $227, which is what you basically paid to make this play. So that would be your max loss, which is great. Now, problem is when it finishes in the middle at like 448 or something, and you have half of this exercise and the other half not exercise. What happens there is essentially if you don't have the money to, purchase 100 shares, which is 44,800 at 448 or 44,500 is where your one is going to exercise. If you don't got 44 grand, 45 grand in your account, you're either going to be put in margin or you're going to have a margin call. And that's not going to exercise until the next day, which really sucks. So they're going to try and sell these whenever they can. So if the price goes from where you exercise, if it goes down below this, then you're in a world of hurt because now not only have you lost the money that you put in, they're going to automatically sell those shares. And if it goes down to 440, that's more money that you have to pay back. So like that would lose you another 500 bucks on top of the 227 because you waited till expiration, the price changed, So you bought them at this price after hours. You can't do anything with your options after hours. And now your brokerage is going to mandate you sell these to get you out of a margin call. And that's the problem with holding till expiration, especially if it's around the prices you're looking at. So, not to panic or anything, but usually you want to sell these things before expiration on Friday is a normal day, but this is a Wednesday because the S&P 500 SPY has calls that are basically every day. So that is the call debit spread, and we can talk about the call credit spread next time.